All right, we're back for chapter 36. This will be our last chapter we cover in the book. This will also be the last instructional video as far as that goes for this semester also. I will be sending out an invite today for a Zoom meeting or a Teams meeting, depending on which one I can get to work. Likely be Teams because I think I get a little bit more time with that and we shouldn't run out of time for the review. But I'll be doing that for the review. Now that will be set up because of scheduling and classes I teach in person and different things. It'll be for 5:30 on Monday afternoon. All right, so 5:30 this coming Monday will be the review. I will send out a Teams invite for each of you with that. So I hope you can join us at that time. We'll be reviewing for the final. And that will cover everything from after the midterm to now. And we'll be able to hopefully get you ready for the final to be able to take it at the end of the week and move on to your next semester. All right, so let me go ahead and get the screen shared here. That moves me to the corner where we can see the screen. And we're going to talk about fundamental changes and what goes into those. Now, this video will likely be shorter than the last one. There are not a lot of slides with this. And we discussed basics of this in the last video. For the most part, changes that are made to a corporation's fundamental structure, changes to the charters, when they combine, they merge, whatever it may be in dissolution. The shareholders have a lot of say within how this goes. We're going to be talking about specific fundamental changes with this that go into it. They're considered an extraordinary change that makes a fundamental change to how the corporation runs, its structure, the corporation itself. That could be the corporation ending, the corporation enlarging by a merger. It could be liquidation to a certain extent that that greatly shrinks the inventory and holdings of a corporation, whatever it may be, something that is considered a fundamental change. When we think about this, it puts a fundamental effect on a corporation and their change by alerting the corporation's basic structure that they fall outside the authority of the board of directors and require shareholder approval. Now, all those, remember, going back to the management, how it's set up, and when we talked about the creation of a corporation, the structure and the direction of the corporation, all those things are set up in the charter, the articles of incorporation, the bylaws, all of that. There are parameters that are set up. Once a corporation goes outside of that, whether it's go below, they get bigger, they get larger, whatever the case may be, we consider that a fundamental change. That can be charter amendments, mergers, consolidations, compulsory share exchanges, dissolution, and sale or lease of all or substantially all the corporation's assets, other than what happens in the regular course of business. And when we get to that one, I'll explain it a little bit more. When we talk about the regular course of business and the assets being distributed or sold. The authority to amend is based upon the statute. Statutes permit the charters to be amended. Everything we've talked about from when we first began studying corporations and now, it's all been based upon statute, because corporations, remember that very first slide in the very first lecture, somewhere within those first couple of slides, it talked about a corporation being a statutory entity. All right, they are a legal entity that's established by statute. All right, so that's why the statutes are where we get our permission to make amendments to our charters. The board of directors would adopt a resolution, and that has to be approved by a majority vote of the shareholders. That happens also when we get into the purchase or lease of all or substantially all the assets. There doesn't change the legal personality of either corporation, but it does change what they're holding. So the exception to that is if something is in a regular course of business. If we're working within that regular course of business, that means that it's what we do on an everyday basis. A corporation such as Walmart or Target, they hold inventory. Their goal is to sell through their inventory, which they then replenish by ordering more. But the goal is to sell it all. So if they have in the back room of a Walmart store, they have 7 cases full of Heinz ketchup. They want to sell all 7 of those cases, or at least down to whatever their reorder number is, as part of their normal course of business. That's their regular course of business. Corporations that manufacture goods that are sold to other corporations, their goal is to sell through their inventory. They create more constantly, but to sell through that inventory. That is a regular course of business, sell or lease, that is happening there. That does not do a change in any way to the corporation, because that's in their structure, right? So what we want to think about is the stuff that reduces the corporation in size, takes it outside of its purview in some way. All right. Approval by the board of directors, shareholders of the selling corporation is required if they're selling enough that it changes their size in such a way. They're selling off equipment that they use, they're selling off property that they use, those type of things. When it comes to a purchase of shares, that's a transaction by which one corporation acquires all of or a controlling interest in the stock of another corporation. A change doesn't occur in the legal existence of either corporation, and no formal shareholder's approval of either corporation is required. In this case, this is where they're buying the shares of it. All right, these are shares that are out there for sale. Anyone can purchase them or buy them. That's called a combination when one is combining with the other. A compulsory share exchange is a transaction by which a corporation becomes the owner of all outstanding shares of one or more classes of stock of another corporation by an exchange that is compulsory on all owners of the acquired shares. The board of directors of each corporation and the shareholders of the corporation whose shares are being acquired must approve this. So when a corporation comes in and they buy through an acquisition, they acquire the shares of another corporation and the shares that are owned by the shareholders in that corporation. They do so by offering a set price, normally based upon the stock price, that share price on the day in which it's announced that they're going to do that, similar to how the dividends are done. But when they announce they're going to do it, they look at what the shares are going for. They will normally offer it for a little bit of a premium. So they're going to give the shareholder something. They're allowing them to make money over it. There was a recent one just in the last couple of days, one corporation purchasing another in this manner. They're acquiring it, and the shares for that corporation, matter of fact, it was Canvas, what we use with our LMS. They're selling to a private equity firm. The private equity firm was offering somewhere around $4 more per share, maybe a little bit more than that, $4 or so per share above the going price at the time that they're giving to any shareholders who own stock in it. So they're going to make a premium on that stock being bought. What that means is the new corporation or that new finance or private equity group, in their purchase of it, they're purchasing all those shares for the face value plus that premium that they're offering on top of it. All right. So that's like you own a house that is worth, $150,000. someone comes in, they make you an offer of $175,000. They're offering you above what your house is worth at that time. You know, that market value may be 150. They want to offer you 175. And that's because they really want to acquire it, and they want to make sure you understand that they're willing to pay extra to acquire it. The reason that a corporation would do this when going after another corporation is they need the approval of the shareholders. They need the approval of the board of directors, but board of directors may not make a decision based so much upon the size of the premium. Shareholders, their whole decision of whether or not to approve a sale or not can be based upon the premium that they're receiving. You know, if I'm receiving $4 on the share above what I already have in it, so if I, you know, holding on to, 400 shares at $30 a share, they're gonna throw another $4 per share in there. I'm gonna make a nice extra amount there. It's not I'm not getting rich off those, but I am getting, enough that, I'm coming out way ahead of where I probably was when I made the purchase. All right. And that goes into consideration. The average price over a set amount of time has been, as a corporation looking to make an acquisition like that, you look at those type of things. Where is that stock been at? What's the outlook for it? While they're doing their research on what the outlook of the corporation is, they want to know too, what's going to be the, likely place we can land where the shareholders will approve this. In a merger, it's a combination of the assets of two or more corporations into one of the corporations. It requires approval by the board of directors, shareholders of both corporations. This is a major purchase and a major sale with these two corporations. So a lot of prep has to go into it, and the shareholders have to approve it because it changes the fundamentals of both the corporations. If it's a short form merger, a corporation owns at least 90% of the outstanding shares of a subsidiary. They can merge that subsidiary into their self, roll it up into their self without the approval of the shareholders of either corporation. They do that because they're the ownership of it. It is a subsidiary. It's a part of that corporation to a certain extent, and they can do that. And most of the time, the subsidiaries, the ownership in that, a lot of times is owned by executives and a few shareholders who have a lot more ownership stake than just your average run-of-the-mill shareholder. The surviving corporation receives title to all the assets of the merged corporation and assumes all the liabilities. The merged corporation ceases to exist. So the one that was brought into it, that was rolled into the other one, that one ceases to exist, and the one who survives maintains their name. If Walmart was to purchase Target in such a way, Walmart would still be Walmart. Target would cease to exist in an instance like that. So you wouldn't have Target, so to speak. You would just have Walmart. Now, for branding reasons, a lot of times corporations will keep storefronts branded the same, even though the corporation that carried that name no longer exists. They will still use the name because they've bought the rights to that name when they get all the assets. So they will still use that name for brand recognition in how shoppers will go about. Walmart has done that with several smaller corporations they use in their online services and online storefronts. They've kept the name of the corporation there, even though they own it fully. When we have a consolidation, a combination of two or more corporations into a new corporation, it's a little bit different. It does require the approval of the board and the shareholders of both corporations, but it constitutes a new corporation. So in that instance, if it was Walmart and Target consolidating, we would end up with something else. You would have Target More, Target Mart, or whatever it would be, whatever name they would come up with, that would be the new corporation. The new corporation assumes all debts and liabilities of both the corporations that were consolidated. When they cease to exist, their debts have to be carried over, their liabilities carried over. The new corporation assumes all that. They get all the assets that go with it. And domestication, the revised act permits a corporation to change its state of incorporation. Currently, we have Tesla doing this and the process of moving their state of incorporation from Delaware to Texas. Musk has announced that he is moving all of his corporations to Texas and incorporating under their statutes and how they work. Conversion is a revised act permits a domestic business corporation to become a domestic or foreign partnership, LLC, or other entity. They're converting to a different form, and a domestic or foreign partnership, LLC, or other entity become a domestic business corporation. This allows a corporation that needs to change its standing to do so, maybe for reasons that maybe financial or some other reason they need to pare down. They can pare down to an LLC, or they can become a partnership, a limited liability partnership, or some other type of business entity. Or if they're at that level and they want to increase, they can. Not every publicly held or closely held corporation just start as a corporation. Some of them do start as small partnerships or sole proprietorships that morph into each step. They may move into each step of the corporate structure. So you could have a sole proprietorship that then becomes an LLC, and from an LLC they may merge and they may become a corporation. They may morph into that depending on how their business is going and how lucrative everything is going. If they're going private transactions is a combination that makes a publicly held corporation a private one. That includes cash out combinations and management buyouts. A lot of times when a corporation decides that they want to have more autonomy, less statutory oversight, and all the pieces that go into that, they may go private. This allows them a few things. It allows them to end some of the reporting they have to do. They're no longer required to do certain reporting. They can begin to merge positions because they will not have to have all the statutory positions that they're required to have. And they can decrease the number of shareholders and the ownership power of others into a more centralized ownership. In the event that a shareholder does not want to agree to some of these changes, they can do what's called dissent. They can be a dissenting shareholder. They oppose the fundamental change, and they have the right to receive a fair value of their shares. What they, in essence, do here is they say, I do not agree with this, and I want to be paid for my shares, get a fair value for my shares, and no longer have any controlling interest or any type of interest in the corporation whatsoever. They may think that it's not going in the right direction, but they do not have enough reason to file a derivative or a dissenting court case with it. So they may just they may not be able to do a dissent suit or a derivative suit, and they just want to come out of it. They can dissent in that manner. When they do this, it gives, or what can give rise to this is the sale or lease of all substantially. So the things we've talked about, all these different type of actions, that's what can give rise to this. Any massive sale or all or almost all of a corporation's assets that are not in the regular course of business, some type of merger, some type of compulsory share exchange, amendments that materially and adversely affect the rights of shares, or conversion to unincorporated or nonprofit status, some forms of domestication, and action that provides the shareholders right to dissent. Dissenting shareholders have what's called an appraisal remedy, the right to receive the fair value of their shares. That'd be the value of the shares immediately before the corporate action to which the dissenter objects, excluding any appreciation or depreciation of such corporate action unless the exclusion would be inequitable. Voluntary dissolution, ways that a corporation will end, may be brought about by a resolution of the board of directors that's approved by the shareholders. When a corporation ceases to exist for whatever reason, voluntary dissolution is where we're winding up the business, and we're going to go through the process of selling off and paying our creditors and doing everything we need to do to shut the business down. That requires approval from the shareholders, of course, because they're the owners and they have to approve that loss of ownership. It's definitely goes beyond the definition of a fundamental change that it's no longer going to be existing. In an involuntary case where there's through some type of administrative or judicial action, it could be an attorney general, shareholders under certain circumstances, or creditors if they show that the corporation has become unable to pay its debts and that they will not be able to do so, they can ask the court to enter into a dissolution. This can also happen if they're not paying their fees, their filing fees, their licensing fees, whatever their fees may be to the state. The state can dissolve it based upon their inability to take care of their debts. When the creditors do this, they ask for them to go into bankruptcy, and not a restructuring, but a bankruptcy to where they have to begin to liquidate everything. They're wanting them completely dissolved, not just restructured. When this happens, a lot of times you go into a liquidation. Liquidation is selling off what you have that can be converted into cash. So whatever items, inventory, property, equipment, whatever type of things that can be converted into cash, that is considered a liquid asset, that has to be liquidated. Then the creditors are paid. Payroll is taken care of, anything that needs to be done. And then if money is left over, we begin to start paying off their shareholders. Remember that you can remember from the financial structure when we talked about that. Any remainder proportionally distributed to the shareholders once we get through paying those creditors and any other types of liens or rights that someone may hold over it. All right, so this chart, and this is the last slide. I told you all this one wasn't going to be that long. Reference this chart. It is in the book, and it gives you an A/B look at how the mergers, consolidations, acquisitions, all of those things work, voluntary dissolution, all of that, and who's required to vote on it and what approval is needed there. All right, so this is chapter 36. It's real quick. It doesn't it holds a lot of information you've seen. A lot of it's very repetitive, so there's not a lot of discussion that goes into it. Make sure you're reading the chapter and be ready to see this on the quiz and the final. You will see parts of this. It may not be written out as an A/B type transaction or instance, but it may have the name of a corporation substituted in the A and B spot. You may see names there, and it'll ask you who is required to approve it and who may, or if there is any approval needed. So I would bookmark this chart. Wouldn't be a bad idea, so that you can reference back to it for any questions on it. All right. So that's once again chapter 36. This concludes your the brand new material that we'll talk about for this term. I will be sending out that invite for the Teams meeting on Monday at 5:30 So I'll send that invite here in the next, within the next hour, my time, and that is 12:24. So you should see it here soon, and that will wrap us up for the semester. So for those of you that will not join me on the review, some of you understand you have work or whatever other reasons. Thank you for a great semester. You have asked some real strong questions, some real good questions, and please do your surveys, the end of course surveys that are linked into East Santa Fe, and also the last assignment that'll be posting if it hasn't posted already. It's a simple discussion post that says, tell us how we did. That's for me personally. I look at it and make changes based upon it. All right. So enjoy your break in between terms, and good luck in all your future endeavors.